Good evening to all. I'm really excited to see such large participation of all my known contacts to demystify and understand in detail the corporate tax regulations. Of late, we have seen so many updates and developments from the regulatory authorities in the UAE for VAT, for AML, for ESR, commercial company law, TRC, visa regulations. And I think it's fine, corporates are finding very difficult to keep pace with the regulations on the one hand and also to manage their business operations. These regulatory changes have been far swifter than anticipated and reflect the desire of UAE to always stay at the forefront of development in the region. It also speaks high volume about UAE as a country and that it quickly reacts to changing business need. That is the reason I believe the country has been a leading global business hub. Today's webinar is to update you on the recently published corporate tax law, and it's important for all the businesses to understand in detail from the overall tax cost and compliance perspective. I have been in the UAE since more than 3 decades, and I can confirm with confidence that the corporate tax provisions are very, very finely drafted after considering the local business environment and the global principles of taxation. I can give you in brief the highlights of the new corporate tax law. First, the corporate tax rate is at 9% in the UAE. It's the lowest in the GCC region, barring Bahrain, which has no tax up to now. Second, there is no income tax on personal or employment income. As a business hub, UAE has promoted small business and startups by keeping corporate tax rate at 0% up to an income of AED 375,000. Also, no tax and lesser compliance is prescribed for smaller businesses having turnover below prescribed threshold limit. Fourth, accepting profit losses as per financial statements prepared using the accounting standards as a base for tax return filing with minimum adjustments for disallowances, exemptions. Fifth, UAE has honored its commitment given to free zone companies by prescribing a 0% rate for free zones. Also, some recommendation to reduce complexities for the free zone companies has been accepted in the final decree law. Lastly, there's no requirement of there's no filing provisional tax return. The corporate tax along with the return can be filed within 9 months from the end of financial year. Along with this, there are also some complex provisions, including the anti-abuse provisions, which the business should be mindful of. My colleagues, Shailesh Kumar, who heads the tax department, along with other colleagues, Radul Gupta and Nandita, will present you important provisions of the new law, and we'll also be happy to answer all your queries at the end of the session or even offline. Thank you, and now hand over the reins to Shailesh Kumar. Shailesh, you take it from now.
Yeah. Thank you so much, sir. And in fact, the wide experience that you have for the UAE, advising the clients in the UAE more than 3 decades or almost 4 decades of experience, and you've seen the landscape of the laws building from the very nascent to maturing now to a matured compliance and tax jurisdiction, from having no reporting requirements to now having a lot of reporting requirements. As you correctly mentioned, within this year itself, we've seen so many changes in the regulatory and the tax framework that at one time it becomes a bit difficult for the businesses to keep up to speed with these changes, but at the same time because of the global requirements and to make UAE as a transparent and compliant jurisdiction, and to make it a investment and development friendly, most of these changes are necessary. So initial teething issues will be there, which businesses will have to adjust themselves for. But for the larger good and for the long term perspective, I think the government is moving in the right direction. And with this corporate tax law, we expect that there will be improvement in the compliance in the country, and improvement in the transparency, improvement in the financial reporting. So all these aspects we'll need to cover. So in this presentation, we'll briefly take you through with the provisions of the new law, how this new law is a final decree law is different from the public consultation document. There were a lot of provisions in the public consultation document which created concerns, and that's why, and it shows the consultative process of the government, that they took suggestions, and many of them they have implemented while issuing the final decree law also, to remove the hardship of the taxpayers. So to start the journey of this corporate tax within UAE, as most of us will be aware, that it was announced for the first time on 31st of January by the Ministry of Finance that the UAE is going to introduce the corporate tax. In April, they issued the public consultation document, and then finally, as recent as last week, which was 9th of December 2022, they issued the English version of the federal decree law on corporate tax. Though we are yet to see the executive regulations and the cabinet decisions, but the date of implementation is final. It is from any financial year starting on or after 1st of June 2023. And the first compliance due date will be 9 months from the end of relevant financial year. So it will really depend on which financial year or tax year corporate or a taxpayer is following. Tax payment also requires to be done along with filing of tax returns. So the same timeline of 9 months from end of the relevant financial year is there. There is no requirement of making any provisional tax filing, provisional tax payment or advance tax payment. And last but not the least is the Pillar 2 framework, which is again an international development, as the corporate tax regime in the UAE has also been statedly introduced as a fallout of the UAE's commitment to the BEPS framework for preventing the harmful tax practices. So this BEPS Pillar 2 framework is applicable for large conglomerate or large businesses which are having a global consolidated turnover of euro 750 million or more. So in this corporate tax decree law that has been issued, they have, along with the FAQs, it has been mentioned that as of now, provisions of this decree law will be applicable on all the taxpayers till the time this Pillar 2 framework is finalized and implemented. After the Pillar 2 framework is finalized and implemented for the large conglomerates, it will need to be seen how this is going to be implemented in the UAE corporate tax regime as well. First of all, I would like to talk about some key highlights or some important changes which have been made vis-a-vis the public consultation document. So first, very important relief, which is important from a small business purpose, is that the government has prescribed that if there are certain small businesses which have turnover below a prescribed threshold limit, they will not need to do the detailed tax filing or detailed tax compliance requirements, including the transfer pricing, and even they may not require to pay any tax. So they'll be subject to very small compliance or reporting purpose. So that provision has been made in the decree law. the turnover threshold will be specified in the cabinet decision. So we'll see as per the cabinet decision, if there are businesses which have turnover below the specified turnover limit, they will be subject to very small tax compliances, though they will need to register for the corporate tax, but tax compliance will be, a burden will be very less. Second important aspect is the real estate income, as we see and meet the clients, and it is one of the very important aspects which comes in various discussions. What will happen to the rental income or the income from the properties which are held by the companies, and so this rental income is subject to corporate tax when it is held by the corporates, but at the same time, when the properties are beneficially held by the individuals, such rental income would be generally exempt from tax. So this word generally is very important, which is deliberately mentioned in the decree law. So we will need to see if in the executive regulations and in the cabinet decision, the government gives an absolute exemption to the individuals to hold the real estate properties, whether commercial real estate property or residential real estate property, and enjoy the tax-free income absolutely, or there will be certain conditions subject to which such income will be tax-free in the hands of the individuals, or if those conditions are not satisfied, probably they may fall within the category of individuals which carry specified business activity and which will be subject to corporate tax. So this is one important area which will need to be watch out for, and we will need to see the executive regulations and the cabinet decision. Another important aspect, which is very important from the UAE economy perspective also, is taxability of free zone persons. As we all know that at the time of introduction of free zones and attracting investments in the free zones, there was a commitment of 50-year tax holiday, which has been given in some of the regulations governing the free zones. Also, we see this written commitment from the government that there will be a 50-year tax holiday. So in line with the government's own commitment, they have mentioned that free zone entities or free zone persons which have a qualifying income will be subject to a 0% corporate tax on such qualifying income. Interestingly, this term qualifying income has not yet been defined in the VAT decree law or even in the FAQs. So we will have to wait for the executive regulations and the cabinet decision to see what will constitute a qualifying income. But if we go by the words which were there, or the language which was there in the public consultation document, we believe that any income which is sourced from outside UAE, or any income which is sourced from other free zone entities, will fall within the definition of qualifying income of free zone entities, and which will be subject to 0% corporate tax. Interestingly, there is no mention of disallowance of any payment made by mainland group entity to the free zone group entity, which was one of the concerns raised post the public consultation document. So no such provision has been introduced in the corporate tax decree law. So as of now, it appears that the payment by mainland group entity to free zone group entity is permissible, but again, we'll need to see the executive regulations and cabinet decision to see the fine print and final implication. One very important, another very important aspect which has been introduced in the corporate tax decree law is the concept of UAE sourced income for the non-residents. So, as a matter of fact, presently the withholding tax has been introduced at a 0% rate. And non-residents which are earning UAE sourced income, whether it is royalty or fee for services or interest or any other income from the UAE, whether it is from the UAE government or from any UAE resident or any permanent establishment in the UAE, all such will be considered as a UAE sourced income, and that should ideally be subject to tax in the UAE in hands of the non-resident which is receiving such UAE sourced income. To make it in line with or in parity with the non-residents which have permanent establishment and which are subject to corporate tax in the UAE. So the decree law makes a provision for this, and they say that any non-resident which is deriving any passive income without having any permanent establishment in the UAE will be subject to corporate tax on such UAE sourced income. Presently, the rate is 0%, but we will need to see as the law progresses. We'll need to see at what rate UAE imposes tax on such UAE sourced income. Another important aspect is the partnership. So, as a general principle, general partnerships are considered as tax transparent, meaning that they will not be considered as a taxable person for the UAE corporate tax purposes, but instead, the respective partners will have to pay tax on their respective share from the partnership. So it means that any partnership which carries out business, respective share of in revenue and expenses of from that partnership will go in hands of the partners, and holding interest in a partnership will be considered as a valid business activity for the natural persons acting as partners in these partnership firms. Again, those partners, those individuals which do not carry business in their own name, but which carry business in name of a partnership firm, will have to register for the UAE corporate tax purposes, and they will need to file their tax return showing their respective share from the partnership. Though there is a provision which says that unincorporated partnerships can apply to the FTA to recognize them as a taxable entity, and so that the partnership firm discharges the tax liability, corporate tax liability, and registered itself as a taxable person in its own capacity instead of taxing their respective partners. So it's actually a compliance burden for the partners. So probably many partnership firms would like to register themselves as a taxable person. So there is a window available for that. Similarly is a case of a family foundation. So we have seen various corporates which, for the purpose of succession planning or for any other family reasons, they hold their assets, personal assets in the family foundations. So as a matter of general principle, family foundation may be subject to UAE corporate tax, but the law gives an option to the family foundations again to go to the FTA and recognize themselves as unincorporated partnerships, so that the respective income or respective investment which is held by a family foundation goes back to the respective family members in their own individual capacity. What benefit or what importance it would have is that, suppose a family foundation is holding investment in form of real estate and earning rental income, then probably if the family foundation is considered as a separate legal entity and a taxable person, then such family foundation may be subject to tax on the rental income. But at the same time, if these are recognized as unincorporated partnership and the income goes back to the individual family members, then probably because of the exemption provided to the individuals, such rental income or investment income will not be taxed in hands of the respective family member. So these are all important aspects which need to be considered. Transfer pricing remains to be one of the most important aspects, and one very important feature of UAE's transfer pricing is that it is not applicable only to the cross-border transactions, but all domestic transactions between the related parties and connected persons within the UAE, whether you are transacting with a mainland entity or you are transacting with a free zone entity, all such domestic transactions will be subject to transfer pricing, subject to the disclosure requirements and documentation. there was a lot of concern about the restriction of interest payment deduction. So in the public consultation document, the interest payment deduction was restricted to 30% of the EBITDA. So that condition is still there, but they have provided a relief that in 1 year, if there is a disallowance on account of excessive interest payment, such excess interest disallowed may be carried forward to next 10 years. And suppose in the next year or any future year up to 10 years, the net interest payment is less than 30% of the EBITDA, such shortfall can be adjusted against the interest disallowed carried forward from the past year. So in a way, such interest disallowance may be a timing difference instead of a permanent difference. The law also provides structuring relief if there is a transfer of assets and liabilities between the qualifying group entities of a qualifying group. Means there should be a minimum 75% common shareholding, or even within the non-group entities, if there is any mergers and acquisitions or amalgamations, whereby the consideration for such business acquisition or mergers or demergers is discharged by way of issuing shares and other ownership interest instead of a cash consideration, then subject to conditions specified in the law, such transactions will be a tax neutral transaction and will not attract taxation. So this is one important relief. Participation exemption, it means that whatever dividend or capital gain income which is received from a foreign subsidiary, that is also allowed. So this actually increases or retains the UAE's attractiveness as a holding company jurisdiction, because it says that if you hold a minimum 5% shares in any other country, and that country is subject to a minimum 9% corporate tax. So except where your investments are held in tax havens which are not subject to tax, if you are holding your subsidiaries or investments in any other country, then your dividend income or capital gain income from such country will not be subject to tax in UAE, which is a very, very important aspect. Similar to that, the branch exemption option is also there, that if you are having, if a UAE resident company is having a foreign branch which is subject to a minimum 9% corporate tax, even that foreign branch will not be subject to tax in the UAE, and that foreign branch exemption can be claimed by the UAE resident company. Last not but the least is the general anti-abuse rules which has been introduced, and this actually requires a lot of consideration because for the first why it is important that these general anti-abuse rules are effective as on today, and as on a date of publication of this UAE corporate tax law in the official gazette. And you don't have to wait for this corporate tax law to be applicable from 1st of June 2023. So any transaction or restructuring which is done from publication of this UAE corporate tax law in the official gazette, these general anti-avoidance rules, anti-abuse rules are applicable, and you have to make sure that the any transaction structuring or restructuring is done, it should be backed by a commercial reasoning and justification instead of just the primary purpose of getting a corporate tax benefit. So these are some key important aspects which need to be taken care of by the businesses. Then I would request my colleague Nandita to take this forward in terms of nuances of this corporate tax, the provisions which are there. Nandita, over to you.
Thank you, Shailesh. Thanks for providing us with a very insightful overview of the entire regulations as of now. It's such a good thing to see such an overwhelming audience in this evening, today being Friday. So I'll try to take you through the other provisions of the corporate tax law, which we thought might be useful for you. corporate tax base. Now, for a resident person who's a natural person, only income from specified business or business activity conducted in the UAE, whether the income is derived within or outside UAE, such income will be chargeable to tax. However, for a juridical resident person, that is the corporates, the global income, irrespective whether it is sourced from UAE or outside UAE, will be taxable in the UAE. For non-residents, however, the taxation is restricted to taxable income attributable to the P, state-sourced income not attributable to the P of the non-resident in that state, and taxable income attributable to nexus of the non-resident. Now, this nexus rule is yet to be notified. Coming to the corporate tax rate, as announced earlier, there will be no taxation for taxable income up to 375,000. However, for a normal taxable person, any income which is taxable above 375,000 will be subject to 9% corporate tax rate. Free zone person, honoring the commitment which were given to these people earlier, the tax rates are slightly different from the normal rate. For qualifying income, the tax rate will be 0%. For any taxable income which is not qualifying in nature, the tax rate is 9%. It's very important to note that UAE is a member of the OECD BEPS inclusive framework. And as such, corporate tax in UAE was introduced as a part of this global minimum tax or Pillar 2 initiative. Under Pillar 2, what has been agreed that a global minimum effective tax rate presently, which is being in discussion, is 15%, will be imposed on large multinational corporations. Large multinational corporations essentially mean those having a consolidated global revenue in excess of UAE dirham equivalent of euro 750 million. Let's go to the next topic, taxable person. Both resident person as well as non-resident person will be taxable in the UAE. However, in the definition of resident person, the following people will be covered. Firstly, juridical person under UAE legislation, which includes, by the way, free zone person. Juridical person under foreign jurisdiction that is effectively managed and controlled in the UAE. Very interesting to note here that even in the FAQs, it has been clarified that effective management and control has to be analyzed on a case-to-case basis. Typically, effective management and control is analyzed by the location where directors are sitting or where key managerial or strategic or commercial decisions take place. But the FAQ categorically states that this has to be analyzed on a case-to-case basis. The third one is my personal favorite because it says only natural person conducting business or business activity in the UAE will be subject to corporate tax. That means all of us here or most of us here having employment income or any sort of personal income in the UAE, including rental income, will not be subject to UAE corporate tax. There may be other resident person who can be brought in the future in the corporate tax bracket. As far as non-resident is concerned, any person who is not a resident person but satisfies one of the criteria will be subject to corporate tax. This will include a non-resident person having permanent establishment in the UAE or somebody who derives UAE sourced income, or thirdly, any non-resident who satisfies the nexus rule. Nexus rule, as I said earlier, is yet to be notified. Similar to the ESR regulation, branch of a resident person in the UAE and the resident person shall be treated as one and the same taxable person. For non-residents deriving UAE sourced income, there is no need to worry as of now because the FAQs have clarified that merely earning UAE sourced income would not trigger CT payable, neither would require foreign entities to register and file CT returns. Now, from the previous slide and what Shailesh mentioned, there's a lot of discussion around PE. P is essentially in lines with the OECD principle, what is given in the decree law. The following types of P are covered under the decree law. One is the fixed place of business P and dependent agent P. Please note, P is applicable mainly in case of non-residents having some sort of establishment in the UAE. Fixed place of business P, as the name suggests, will be constituted if a non-resident has any physical presence, which can include a branch, a workshop, or even a construction site wherein the installations are there for more than 6 months. Dependent agent P will essentially include a person in the UAE who is habitually concluding contracts on behalf of non-resident or habitually leading to conclusion of contracts which are generally concluded without material modification by non-resident person. So the UAE FTA has been very liberal here in stating that person with principal role in negotiating contracts will not be covered. If you see the OECD Model Tax Convention, the Article 5 has broadened the scope of P to include any person who plays a principal role leading to conclusion of contract. There might be other forms of Ps which might be notified at a later stage. A very good relief which is available for individuals who travel to UAE frequently. And this is good because now the visa norms are being, simplified and they're trying to issue 5 years visa, etc. So what these conditions say that mere presence of a natural person in UAE will not trigger a P in UAE for a non-resident person, where such presence is temporary and exceptional, or where the natural person is employed by the non-resident person and the following criteria are met. The criteria which are prescribed are as under. First, the activities conducted by the natural person should not be in the nature of the core income generating activities of the non-resident person, and the employer who's non-resident should not derive any UAE sourced income. This is a welcome relief as we see there are many employees of foreign companies who frequently travel to UAE for business purposes. So in UAE, another typical problem is that there are non-residents owning real estate in the UAE. Now, because real estate can form fixed place, the P impact for such non-residents may be needed to be assessed. Exempt person. Typically, exempt person includes persons which perform the sovereign functions. That means government entities as well as government controlled organizations, persons which are subject to emirate level taxation. This will include person engaged in extractive as well as non-extractive natural resource business. Now, pension, social security fund or qualifying public benefit entities, let's say charitable organization, religious organizations, chamber of commerce, which are notified in the public gazette will also be included. Qualifying investment funds also will be included, and there will be more people who might be notified at a later stage. Exemption for all of this people is not necessarily automatic. There has been a list of people who are required to make an application to claim exemption. The list is on the right hand side of the slide. Moving on to the next slide on free zone person. As per the definition, a free zone person is a juridical person incorporated, established, or otherwise registered in a free zone. The definition has very nicely clarified that it will include a branch of a non-resident person registered in a free zone. It still remains a question whether a branch of a resident person registered in a free zone will qualify as a free zone person. So as Shailesh mentioned earlier, qualifying income definition has not been provided as of now, but we see that it will be in line with the public consultation document. There are some conditions the free zone person should meet to classify as a qualifying free zone person. One is that it should maintain adequate substance in the UAE, that is ESR compliance should be done. It should not have elected to be subject to corporate tax, and it should comply with the UAE transfer pricing provisions. Other conditions may be prescribed. Tax grouping. Tax grouping is possible only in case of parent-subsidiary relationship, and an application has to be filed to form a tax group. So the conditions which are prescribed to form the tax group are as under. The resident person should be juridical person. Parent company should either own, hold, or should be entitled to 95% of share capital, voting rights, profits, and net asset of the subsidiary. None of the companies should be exempt or qualifying free zone person. Same financial year and accounting standards should be followed by the companies of the same group. Important to note here that foreign entity which is effectively managed and controlled in the UAE is considered as a UAE resident person for UAE purposes. Subsequent addition of company to tax group is possible. There's a requirement that the parent company will have to prepare a consolidated financial statement. Needless to say, the threshold of 375,000 dirhams will be applicable quad the tax group. There's an important twist or twister which is there in the tax grouping. The twist is such that it says when a loss-making company joins an existing profit-making tax group, the loss of such company can be set off only against the income attributable to the this company in the tax group in the future years. Similarly, when there's a profit-making subsidiary joining a loss-making tax group, the losses of the tax group cannot be set off against the profit of such subsidiary. This is like a specific anti-avoidance or anti-abuse provision which is introduced in the tax grouping. As far as calculating taxable income is concerned, the calculation is quite simple. The starting point will be accounting profit and loss as per the financial statements prepared as per the accounting standards. Very few adjustments are prescribed. Any sort of income which is exempt or out of scope or specific relief is available in the UAE corporate tax, such income should be excluded. As far as non-deductible expenditure is concerned, it's of great relief that as of now, there is no adjustment for depreciation or provision for doubtful debt or bad debt or whatever name you call it, which is prescribed. The other non-deductible expenditure are unrealized gains or losses on capital items, expenditure incurred which is not for business purposes or which is of personal nature or which is incurred for earning exempt income. Prior period expense will be disallowed. Interest, there are specific deductibility allowance rules. 50% of entertainment expenses will be disallowed. Important to note here that entertainment expenditure which is incurred on employees is allowable as of now. Donations to non-qualifying public entities, fines and penalties, dividend distribution, corporate tax or recoverable VAT will be non-deductible expenditure. Tax loss. Tax loss can be set off only up to 75% of taxable income of each subsequent period. Setting off is not at the discretion of taxpayer, which essentially means it should be done year on year against taxable profit of subsequent years. Tax relief, tax loss relief is not allowed in certain cases wherein the loss is incurred before the date of commencement of corporate tax, or loss is incurred before a person becomes a taxable person, or it is incurred from an asset or activity which is exempt or out of scope of corporate tax. Transfer of losses between juridical resident taxable person is very much allowed in cases where there is 75% of common shareholding and where both the person have the same financial year and accounting policies. The corporate tax calculation or payment criteria is very much the same as other countries. The corporate tax due must be first settled against withholding tax credit, secondly against foreign tax credit, thirdly against any other credits relief which may be notified later. Fourthly, when you exhaust the credits which are available to you, whatever balance tax payable is there, you need to make a payment within 9 months from the end of relevant tax period. Important to note here, in case of foreign tax credit, it will be restricted only to the corporate tax due in the UAE on relevant income. That means free zone person who are claiming the 0% tax rate may not be able to claim foreign tax credit. Secondly, if you have any unutilized foreign tax credit, you cannot carry forward or carry back such credits. And to claim foreign tax credit, most important is you need to maintain the necessary documents wherein you show that there has been tax deduction in foreign jurisdiction. Another important point is that tax refund procedure in the UAE. Tax refund will not be automatic. There is a requirement to make an application to the FTA for tax refund. All corporate tax payments or all corporate tax computation should be in AED. The rate at which conversion should be taking place is yet to be notified, but essentially it will be done by applying Central Bank of UAE's exchange rate. Transfer pricing, very important provision here because it is applicable to all person, including free zone person and exempt person having a non-exempt business. It is not applicable to the members of the tax group. As a part of transitional rules, it has been specified that the opening balance sheet for the first tax period should be prepared considering arm's length principles. That means the corporates have to really act very quickly to ensure that the closing balance sheet before the first tax period meets the arm's length principle. So which are the transactions for which transfer pricing is applicable? Transfer pricing is applicable for transactions or arrangements, informal or non-formal arrangements with related parties. Related parties essentially include relatives up to the 4th degree of kinship, upward and downstream subsidiaries with more than 50% holding, PEs, etc. Transactions with connected persons are covered under transfer pricing provisions. However, in connected persons, people included are directors, key management personnel, or their relatives. A relief is provided for connected persons of a listed company. The connected persons of a listed company, the criteria of transfer pricing may not be applicable, and the deductibility of such expenses allowed even if perhaps the transfer pricing regulations are not complied with. Transactions between exempt and non-exempt person of business of same person, such transactions are subject to transfer pricing. As Shailesh mentioned earlier, methods to determine arm's length price are prescribed as per OECD. If you want to divert from the methods which are prescribed from the OECD, you need to demonstrate that none of the methods are applicable. So far as the documentation is concerned, there's a requirement to file a transfer pricing disclosure form along with the tax return. Master file and local file should be maintained but furnished to the tax authorities within 30 days of request. Important provision of advanced pricing agreement has been introduced, wherein you can approach the FTA to mutually agree at an arm's length price. Generally, in the developed jurisdiction, such agreement is made for a period of 4 to 5 years. Needless to say, businesses that claim small business relief may not have to comply with the transfer pricing documentation rules. General anti-abuse rules. I get serious chills when I even read the term, because this will be applicable even as on date. The rule, sum and substance, say that the FTA has an authority to disregard any transaction or arrangement which is made without a valid commercial or fiscal reason, and the main purpose or one of the purpose is to obtain corporate tax advantage. There are few instances of corporate tax advantage which have been stated. This is not an exhaustive list. This is just an inclusive list. While the FTA will give you a right to or opportunity of being heard, because this is general anti-abuse rule and not specific anti-abuse rules, you need to be very careful. So I've already got chills because of this GAR. And so I will hand over the baton to my colleague Mridul, who will take you through the other provisions of the corporate tax law. Mridul, over to you.
Thank you, Nandita. That was indeed insightful. So we'll proceed with the other relevant provisions. First one being registration. So what is being prescribed under the CT law is that every taxable person needs to be registered on or before the filing of first CT return. And that application for CT registration has to be made irrespective of whether the business is already registered for VAT or excise purposes earlier. The next is on tax return. The CT return needs to be submitted before on or before 9 months from the end of the relevant tax period. Even free zone businesses needs to submit the CT return because they are considered as a taxable person. Tax return needs to be submitted even in case where there is no income or in case of dormant companies. Some simplified procedures would be prescribed for small businesses. The FTA may request certain exempt persons also to submit a declaration. Next is on record keeping. So both taxable person as well as exempt person needs to maintain records for CT purposes, and those records needs to be maintained for 7 years from the end of relevant tax period. An application to tax authority may be made in order to seek clarification on any technical matters, as well as for advanced pricing agreement for transfer pricing purposes. In case of international agreements, what has been stated is that these international agreements, such as the DTAA, will limit the application of UACT regulations in respect to right to tax certain item of income, which seems to be that in case of any beneficial provision, the international agreement will prevail over the UACT law. In respect of assessment and penalties, the current tax procedure law, what has been provided by FTA in 2017, that should cover the scenarios which has been prescribed therein, plus the cabinet decision that was provided in 2017, which was amended and updated on a timely basis, even for VAT and excise purposes. We might see further amendments to provide for any specific penalty for the purpose of UACT law as well. Next slide. So we have summarized a comparative between the current UAE VAT law vis-a-vis the UAE CT law. So we are familiar with the free zone concept here in UAE. Prior to the implementation of VAT law, free zones, the company set up in free zone considering that there was no taxes prevailing in UAE, there was not much of a difference when it comes to tax purposes between an entity set up in a free zone vis-a-vis that in the mainland. When the VAT law got introduced, there were certain benefits which were passed on only to designated free zones, the ones which were gated, and for other free zones, those were for taxing purposes, those were similar to that of a mainland company. Now, even for the purpose of UACT law, they have specified that only qualifying free zone persons generating qualifying income would be deriving some specific benefit out of the UACT law. In case of PE, what we have seen in UACT law that any natural person of a non-resident person who is not deriving any UAE sourced income or is not involved in core income generating activity of that non-resident person, that would not lead to formation of PE of the non-resident person in UAE. However, we have seen in UAE VAT law when an amendment had come for Article 31 of the executive regulations that even a stay of a single day by a non-resident person, and that stay happens to be in relevance to the performance of services by a UAE-based service provider, that could lead to formation of PE of the non-resident person in UAE. Next is on tax grouping. Under UAE VAT law, 50% or more voting interest, market value, or control, if this condition is established between members of between two or more entities, those two or more entities can come together and form a VAT group for the purpose of VAT law. Whereas in comparison to UACT law, there has to be a parent subsidiary relationship, and the parent must hold at least 95% in the subsidiary in order to form a tax group for UACT purposes. The other fundamentals in terms of transactions that being undertaken between members of the tax group remains the same for VAT as well as for CT purposes. Next is on registration. So we have three different scenarios when it comes to registration for VAT law. Below 187,500, one may not be able to take registration. Between 187,500 to 375,000, the registration application becomes voluntary, and above 375,000, it is mandatory. Whereas in case of UACT, there is no minimum threshold applicability, and the businesses who are registered for VAT would also need to apply separately for UACT registration. Record keeping for VAT law, generally it is 5 years from the end of relevant tax period, and for real estate related records, it is 15 years from the end of relevant tax period. When it comes to UACT law, the records needs to be maintained for 7 years from the end of relevant tax period. Few other aspects would be in case of deregistration in UAE VAT law, if the turnover falls below the voluntary limit of 187,500, then an application for deregistration has to be made, apart from the situation wherein the businesses cease to exist. Whereas that compared to UACT, the deregistration application needs to be made once the businesses cease to exist. So we all would be well versed by this proverb, a stitch in time saves 9. So many of the businesses would have come across or would have encountered about the impact that the businesses receives when it comes to not being able to timely implement or not being able to be prepared for any of the tax laws. We have seen that case when it came to implementation of VAT law in UAE. So similar to that, as we all know that the CT law is upcoming and we have almost more than 6 months now before this law gets implemented. So I will hand over to Shailesh, who can guide us in terms of how PKF can help businesses in UAE to timely and correctly implement and be prepared for UAE purposes. Over to you, Shailesh.
Thanks, Mridul. Thanks, Nandita, for the detailed debriefing of the corporate tax law. So before we quickly go to the question and answer, and I can see that there are a lot many in the chat box. So we'll try to take up as many questions with our answers as many we can. And please feel free to reach out to us offline also for anything that you require, any assistance or advice that you require. So quickly on how we can help the corporates and businesses to prepare for this new law. So first of all, we can take training sessions and we can help you understand the corporate tax provisions. We can do a deep analysis of your business structures, your transactions, and to help you understand and assess the impact of this new law on your business, on your bottom line. As it is definitely a 9% cost for the businesses which are not exempt or which are not free zones. We can help you in making the structures compliant with the UAE corporate tax law, in getting the documentation, getting the IT systems ready also, so far as if the systems already do not provide for identification of related parties or expense items which are clearly disallowable under the CT law. So we can help you identification of those items and implementation in your accounting or SAP system. We can help you with the transfer pricing benchmarking, making of transfer pricing policies, the review of intercompany agreements, or even if you don't have any, we can help you make one. So that which is important. And lastly, in obtaining the tax registrations and making all the compliances which will come in the due course. So please feel free to reach out to us. Now we'll start with the question answer session. First question is from Mr. Rakesh Sharma, who our financial year is calendar year. What would that mean? We will not be subject to income tax even if your net profit for 2023 exceeds 83,75,000. Answer is yes, it appears so. For you, it will be applicable from 1st of January 2024. The next question is from Mural. For wealth management companies in DIFC, are they subject to tax? I know it is 0% taxation. As we mentioned, free zone entities will not need to see the cabinet decision and executive regulations, which all free zones are considered to be as qualifying free zone. And what will be the definition of qualifying income. But yes, based on the understanding of public consultation document also, it appears that any income of wealth management companies which are located in DIFC, which is sourced from outside of the UAE or from the clients in the other free zones, it may be subject to 0% corporate tax, whereas any income which is sourced from the UAE mainland, it may be subject to 9% corporate tax. Next question is from Harshit. In this, it will be applicable from 1st Jan to December 24. Yes, if your financial year is the calendar year, then it is of course applicable from 1st Jan 2024. Zero taxation for 50 years. As we mentioned, we'll need to see the guidelines and regulations for executive regulations and cabinet decision for definition of qualifying income. When is the executive regulation and cabinet decision expected? Anytime soon? We can't commit, or we don't know the date actually. Having financial year Jan to DEC, tax period start from Jan 23 and first return in September 24. No. Having a tax period Jan to December, first tax period start from Jan 24 and the first return will be September 2025. Next question is from Vijayashri. There is no need to restructure business to carve out non-qualifying income from qualifying income in free zone entities, correct? Yes, Vijayashri, it appears to be correct. Only thing is that you will need to maintain the segmented account segmentation of your income from free zone as well as non-free zone income. So if those segmentation accounts are prepared, and so there may not be a need to restructure the business. But as I mentioned earlier, the devil lies in the details. So let's wait for the executive regulation and cabinet decisions. Next is Harshit. Same question first, so we skip this. For FY September, what would be the first return? For FY September, the first due date will be FY September will be June 30th of June 2024. Ours is a no, not first June, rather is for 30th of June 2025 rather. Ours is a ship owning company. The vessels are owned by a single SPC in Marshall Islands. The vessels are traded worldwide and are in international transportation. Hence, please advise it will be taxable rate for 0%. The management personnel are based in Dubai and decisions are taken. So this is very interesting actually, so it requires 2-3 aspects. First is that if there is a ship owning company which is into the international transportation, and if it is a non-resident, then you can claim an exemption, because non-residents which are into international transportation are provided an exemption from corporate tax in the UAE. But at the same time, you are mentioning that the management personnel are based in Dubai, and if by way of that, if they are considered to be resident in the UAE, then this exemption will not be applicable. You will have to pay corporate tax. So it will be your poem. So this poem is a subject matter of detailed examination. We request you to keep in touch with us offline, and we'll be happy to help you on that. What if we are a representation office and only have OPEX, no revenue? Then if you are a representation office of a foreign company, then possibly you can get covered within the definition of preparatory and auxiliary activities, and may not be subject to corporate tax or permanent establishment. We will need to see your activities though, to see whether you will fall within the definition of preparatory and auxiliary. So this will require a detailed examination of your activities. We are registered. Mr. Dilip is asking, we are registered in free trade zone and our income is not in mainland but merchandise trading outside UAE. Are we eligible for tax? Yes, if you are, as a simple answer, we can say that if you are in a free trade zone and your income is from outside UAE, it's possible that your income may be subject to a 0% corporate tax. Again, but for compliances, you may need to obtain the tax registration, file the tax return, and maintain a statement of qualifying income, non-qualifying income. So that will be required to be done. What do you mean by qualifying income? Murali is asking. It's $1 million question again, because it will be defined in the executive regulation or cabinet decision, which has not been done either in the FAQs nor in the decree law. Patrick is asking, please, could you share the PowerPoint presentation? We will definitely. Abraham, ours is a shipping company acting as a commercial manager for a foreign company. The commercial decisions on shipping routes, rates are all taken by us, and invoices, BLs are issued on our letterhead. Would like to know if the income, yes, if you become a dependent agent of the foreign shipping entity, and then it is possible that that foreign shipping company will be deemed to have a permanent establishment in the UAE, and therefore we'll need to examine your activity, what you are doing, whether you are an independent agent or you are a dependent agent. So all those activities we'll need to examine to comment on whether your activities can constitute a permanent establishment for your non-resident principal. Mr. Jairaj is asking whether companies under common ownership, no parent subsidiary form a tax group. No, it is not possible. For forming a tax group, you must have a parent company. Are financial statements required to be audited? It is specifically mentioned in the FAQ that the government will prescribe in the cabinet decision about the conditions or a threshold limit which must for getting the mandatory audit done. There is no prohibition from getting a voluntary audit, so you can always get your accounts financial statement audited, which gives more credence to your financial statements. So generally we advise the clients to get their accounts audited, because if the FTA asks, then there is an auditor stamp on that financial statements to be true and fair and reflecting a correct profitability. On a advisory basis, yes, you should get it audited, but on a mandatory basis, we will need to see the cabinet decision to see the threshold for which under which it will be mandatory. If the transfer pricing, Vijayashri is again asking if transfer pricing provisions applicable for transactions between free zone and related mainland company. Yes, they are applicable. Then Mr. Nadeem is asking how the income to be calculated for real estate developer based on percentage of completion, since the project are more than 3 years normally. So it will depend on the accounting policies and principles that you are following. If you are following IFRS, then it will be most likely you will need to calculate your taxable income as per the IFRS, and the adjustments which are permissible or adjustments which are prescribed in the corporate tax law, the same adjustments will require to be done. So as a general principle, taxation income or taxable profits will follow the accounting profit. So the way you do draw your accounts, audited accounts, taxable income will be calculated based on that only. Small shops, Mr. Madhusudanan is asking, small shops has to register life criteria, etc. This will be subject to the small taxpayer benefit or small taxpayer relief. We still need to see the conditions for that. So based on the final conditions, cabinet decisions, we will be able to advise more on the applicability. We have a free zone branch in UAE, whether we need to apply for the CT registration. Yes. Yeah. So even foreign branches. From this question, it's not clear whether it is free zone branch of a resident UAE company or a non-resident company. If it is a branch of the UAE company only, UAE resident company, anyway you have to register. And even if you are a branch of a non-resident company, you have to register for the CT registration. Harsha is asking how law will treat related party non-residence entities with no presence at the country that have income from resident entities. As of now, there is no compliance requirement for non-resident entities having no presence or no permanent establishment in the UAE. Even the source rule is prescribed, but it does not give any mechanism or any rate for taxation. So as of now, any non-resident entity which has no presence in the country may not be required to comply with the transfer pricing regulations here or registration in the UAE. Share cost between Mr. Santosh is asking a share cost between the group entity. What will be the treatment? So you will have to allocate it based on a proper allocation key and the transfer pricing principles between the group entities. Ms. Bindu is asking, is transfer pricing applicable if we hold 40%? So the criteria for transfer pricing is 50% minimum. So if it is simply 40% stake, transfer pricing may not be applicable, but you will need to see the other conditions for control, because control is not merely based on the shareholding, it is based on the other criteria also. If you are able to influence the decision of the other company, transfer pricing may be applicable from a control perspective. For sale from mainland to free zone, will tax be applicable? Yes, tax will be applicable. Does royalty payment from mainland to related free zone IP owner allowed as a deduction is qualifying income defined? So as of now, there is no prohibition in the decree law on payments made by mainland to related free zone entity, as it was earlier in the public consultation document, in the decree law and in the FAQs which are released just now. So there is no prohibition, but we need to see the definition of qualifying income if it provides any prohibition or restriction on that. Owner's salary shared between a group entity, what will be the treatment? Again, it will be subject to transfer pricing. So if the transfer pricing is complied with and the salary, it can be shown that the salary is paid for the business purpose, it is so then it can be allowed as deduction. How the tax will be calculated if profit is 450,000 including depreciation? So it will be 9%. Yes, So it will be 9% on 75,000. You have to reduce the basic exemption limit of 375,000. Individual rental income from commercial property is taxable. As of now, it is not taxable, subject to the cabinet decision, where if they prescribe it within the definition of specified business activities which make an individual subject to corporate tax. Whether TP applicable to branch in UAE free zone of a non-resident P, yes, it is applicable. Another question, is it not an inconsistency from a tax point of view for the businesses that would be benefiting just because they follow the calendar year as their financial year, as opposed to those, for example, who have July to June? So there is an inconsistency, but that's how the law is designed. We can't do anything. So the law is being implemented in a phased manner. So they have not prescribed any fixed financial year. So if the law would have prescribed that any fixed financial year like calendar year for applicability, then it would have been applicable same for every businesses. But because it is not, so this inconsistency is inbuilt in the law. We can't do anything. Thank you. How to fix salaries of actively working partners of LLC? Up to what level it will be deductible? Again, it will depend on it will be based on the transfer pricing and rules, executive regulations, if they prescribe any. Transaction between group companies, sales and purchases from free zone and mainland, it is under TPS. Mr. Ajay Kumar is asking, please suggest in a case where director of free zone entity is a citizen and tax resident of India, but also have residence permit in the UAE, will director be considered resident for tax purpose in UAE as well, or the tiebreaker rule will apply? Yes, the tiebreaker rule will apply. So we will have to see the new tax residency rules which are applicable from 1st of March 2023. And the tax treaty between India and UAE to see the place from where the individual director has more closer economic and social ties, and depending on that the final tax residency will be applicable. Please clarify on city laws for companies operating in DMCC free zone. Again, we'll have to see whether DMCC we'll need to see the executive regulations to see the qualifying free zone and qualifying income. Most likely it will be subject to a 0% corporate tax. We can share the PPT. Any limit issue with drawing salary by partners from company? Will it be allowed as cost? Yes, it will be allowed as cost, subject to two conditions. First, it is for the business purpose, and second, it is subject to it is permissible as per the transfer pricing. What document can be given to substantiate the arm's length price by a recipient? Suppose A Limited has given one contract to B Limited. TP auditor has asked B Limited to prove the ALP. So this document, actually transfer pricing requires a detailed documentation requiring the function, assets, and risk analysis of all the entities in the value chain, and depending on that detailed analysis, one can determine the arm's length price. We can help you with that if you require. Is interest on loan from a shareholder a deductible expense? Yes, generally it is deductible, subject to conditions that the interest is not utilized for making further capital investment. So there are certain limitations which are provided in the law. If your interest on loan is, or utilization of loan is not for those prohibited purposes, interest on loan from shareholder is also deductible expense. Interest on lease, is it covered in 30% threshold? Yes, all kind of interest is covered within 30% threshold. Please advise if directors are considered as connected person. Yes, directors are considered as connected person. And in such a case, entity in which director have common directorship will be treated as connected. Yes, it can be considered as that entity can also be considered as a related party or connected person. Will UAE follow IFRS or US GAAP? Generally, it follows IFRS, but we request that you can contact with your auditors to determine which accounting principle should be applicable for you. We can help you on that also. Our company is registered under DMCC and we are aviation trip support. Our services are both outside and inside. How will be tax applicability? Most likely it will be a proportionate basis. Whatever income is generated from outside may be subject to 0% tax. Whatever income is generated from within mainland, it may be subject to 9% tax. Again, we will have to see the executive regulation and cabinet decision. Thank you. We will share the PPT. I think there's one question. 50% of many companies are owned by locals as sponsor. He will be holding many companies. How will be his income treatment? We will need to see his income details. What all income stream is, whether his income qualifies within any specified business activity or not. If not, then he may be non-taxable. But if his income is qualifying between any specified business activity, then he may be subject to corporate tax. Is there any tax base for depreciation? As of now, they have not given any tax base for or any separate adjustment for depreciation. Is there any clarity on limit of salaries to be paid to the owner directors? As of now, they have not prescribed any limit. It will only be subject to transfer pricing. And then we have all thank you notes. Understood that qualifying income are not yet clarified. Do you expect the capital gain on shares of UAE companies owned by Free Zone will be considered as qualifying income? Again, we wait for the executive regulation to say that. In the decree law, nothing of that sort is mentioned. Article 30 interest deduction. Can you please elaborate? Why do article mentions net interest shall not be deductible? What may be included in the interest income? It is essentially, it is actually a beneficial provision, because if there is a company which is into financing, which borrows and lends and derives income as well as expense, only the net amount will be disallowed. Interest income. Interest income is not defined as such, but I think it will go, the definition will go hand in hand with the interest expense. It's just the payer and payee difference. And to add my further question above, Article 30 and net, do you need to have any sort of nexus? No, there is no nexus which is required. It just talks about interest income and interest expense. So you can have, borrowing one from one person and lending to other person for any purpose. So there's no restriction that there should be any nexus between the interest income and interest expense. I think we have covered most of the queries. Is there any clarity on bad debts written off? No, there is no. So there's no clarity means there is no separate adjustment. So by natural corollary, we can assume that bad debts are allowed. So if are the debts provided before the act and written off under after the tax act allowed is deductible? Rishikesh, we can talk offline on that. Sponsors are involved. I think we have taken up most of the questions, and if there is any further questions, we'll be happy to help you. Please feel free to reach out to us. Our contact details are in the screen, and we will share a copy of this presentation and the recording also. So thank you so much for your patient listening and the time. Thank you.
Thank you, everybody.
Thank you all.